Welcome back to the Did You Know channel. If you're new here, just a quick heads up, you can totally play this in the background. No need to stare at the screen. Feel free to listen while you're cooking, cleaning, driving, or just relaxing. It's more about what we talk about than what's on the screen. For those of you who've been around for a while, you already know that sometimes we dive into what's happening on the markets, the economy, and everything connected to that, in a way that's simple, human, and without any unnecessary jargon. And today we're going to break down what's really going on in the markets, why everything seems a bit shaky, where a potential bottom might be forming, and whether we could actually be close to a major turnaround. I've got some data, some stats, and most importantly, my own take on all of it. So let's get into it. The markets have taken quite a hit lately. If we look at something like the Nasdaq ETF, it's dropped around 14%, which is a pretty solid decline. It's not a total meltdown, but definitely more than just a little dip. And over the last few days, I've noticed things are starting to calm down a bit. Not in the sense that everything's great, but more like the market is just moving sideways. This sideways movement, or what we call consolidation, feels like the market is just waiting for something to happen. Either a positive catalyst that could push it back up, or some negative news that could drag it even lower. And it's not just Nasdaq. We see the same thing with SPY. That's the ETF tracking the S&P 500. That one's entered what's technically called a correction, meaning it's dropped more than 10% from the top, but not more than 20%. Because once it drops past that, we're talking about a bear market. So far, we're still in correction territory. When I looked at the chart recently, the last few days have been suspiciously calm, multiple days in a row where the price barely moves. And honestly, that kind of stillness usually means the market is gearing up for something. The question is it a bounce back up or another leg down? It's that quiet before the storm kind of vibe. And just because it's calm doesn't mean everything's fine. In fact, it's often the opposite. I get the sense that investors right now are really torn. Some are hopeful, some are nervous, and that tension is exactly what we're seeing in the charts. The market's just sitting there, holding its breath. So now we're getting to the question that I keep asking myself. And honestly, probably everyone who's been watching the markets lately is wondering the same thing. Where is this all heading? Have we hit the bottom already? Or is there another leg down waiting for us before things settle? And to be totally real, there's no way to know for sure. In the short term, it's almost like flipping a coin. We've got data, we've got experience, we've got our charts and trend lines, but in the end, the market does whatever it wants. And that's exactly why a lot of investors don't even try to time it perfectly. They just watch, prepare, and build strategies that can handle different outcomes. The way I see it, we're in a phase where there are just way too many unknowns. Volatility is still high. And I don't mean just the gut feeling kind of high. I mean it's confirmed by the VX, the so-called fear index, which is still showing elevated levels. And this VIX data suggests we might see heightened market tension, at least until the 24th of the month. Why the 24th? We'll get to that later, but trust me, it's a key date that could shake things up. Right now, the whole market feels like it's holding its breath, like something's coming. You just don't know when or what exactly. And that's totally normal for markets. Everyone's watching news headlines, central bank updates, economic indicators, and still, we're all asking the same thing. Is the worst over, or is it yet to come? And honestly, when it comes to the short term, anything can happen. That's why I don't try to force it. I know this phase requires patience, and more importantly, it requires being ready for anything. Because right now, the market reacts to every little thing. Sometimes irrationally, sometimes violently. And that's the nerve-wracking game we're playing in this moment. You know, when I look at what's happening in the markets right now, and more importantly, how people are reacting to it, I get this feeling that maybe, just maybe, we're getting close to the bottom. Now, I don't mean that as a bold prediction like tomorrow we're going up, but more as a general vibe backed by what I see in the data, investor sentiment, and a bit of historical context. It's one of those paradoxes. The more negative people get, the more fear there is, the higher the chances that we're nearing a turnaround. And that's exactly what I'm seeing now. Just scroll through social media, look at the comments under finance videos, read investor forums. It's all doom and gloom. Crisis this, recession that, everything's going to crash. The mood is incredibly dark right now. But here's the interesting part. History has shown us something really important over and over again. The market often bottoms out before the actual problems get resolved. Take the Cuban Missile Crisis in 1962, for example. Massive geopolitical tension between the US and the Soviet Union. Markets were dropping, fear was everywhere. But you know what? The market hit its bottom on day 7 of the crisis, before any resolution even happened. And then, it started climbing. That's the tricky part. Most people are waiting for a clear green light, some kind of everything's okay now moment before they invest again. But the market doesn't wait for that. It starts moving up while everyone else is still frozen, waiting for permission. And that's why so many people end up selling at the bottom and buying at the top. Not because they're clueless, but because the market plays by its own rules. So, when I see all this fear and doubt and this collective nothing makes sense anymore kind of sentiment, I start thinking, all right, maybe we're getting close, because that's exactly how things felt at the bottom in previous cycles. And sure, maybe we're not there yet. Maybe there's another little dip to come. But if that happens, I think it's more like an aftershock than the start of another full-on crash. Since we're already talking about how people feel about the markets, let's take a look at what the actual data says. Because, yeah, personal feelings are one thing, but when emotions start lining up with hard numbers, that's when things really get interesting. I came across a recent study from Bank of America, and it showed that right now, the biggest fear among investors isn't inflation or some AI bubble or even geopolitical conflict. It's tariffs. Trade war fears are the top concern. That's a huge shift. If you look at the data from January through March, fear of a global recession triggered by trade war shot way up. And by March, it was the #1 worry on the list. But here's the weird part. When you look at how the countries that are being targeted with these tariffs are performing in the stock market, they're actually outperforming the S&P 500. I'm serious. China's up plus 19%, Europe plus 12%, Mexico plus 8%, Canada plus 2%. And think about that for a second. If a real trade war was coming and these economies were heading into a recession, their markets should be crashing, right? But they're not. They're climbing. To me, that says one thing. Right now, tariffs are being used more as a negotiation tool than an actual trigger for economic disaster. It's more politics than panic. Sure, the media is blowing it up because fear sells. But when you look at the bigger picture, nothing major has actually happened yet. Even the Fed says that if tariffs do come into play, their impact on inflation will likely be temporary. And it gets better. The American Association of Individual Investors, that's basically regular retail investors like you and me, just reported the most bearish sentiment since 2022. Some of the data even lines up with levels we saw during the 2009 financial crisis, when markets were down more than 50%. And you know what happened back then? Right in the middle of all that fear, the market hit bottom, and a new bull run began. So, if you're feeling like everything's falling apart, if people around you are panicking, if it seems like no one believes in stocks anymore, that might actually be a good sign. Sentiment, in many cases, is the best contrarian indicator out there. All right, so we've talked about investor sentiment, fear, and the big picture numbers. But now, let's get into something I personally find really interesting, the technical signals. Because while they're not magic, they can give us a pretty solid hint when something on the market is starting to shift. One of the indicators I keep an eye on is the put-call ratio. Basically, it shows how many people are buying put options, betting the market will drop, versus call options, betting it'll go up. And lately, this ratio has gone above 0.90 comma, which is pretty telling. Why? Because normally, most people buy calls. We're naturally biased toward optimism, but when this ratio gets close to 1, it means there's a ton of fear out there. And historically, those moments often mark a turning point. When everyone's bearish, that's when things start to flip. Another thing I look at is advance and decline volume. The volume of shares moving up compared to those moving down. And just last week, something interesting happened. On Friday, more than 80% of the volume was in advancing stocks. That's a strong signal. When you see that kind of volume push in the green, it often shows up right as the market is bouncing off a bottom. Then there's the VX, the so-called fear index. It measures expected volatility in the market. In other words, when the VX is high, people are expecting the market to make big moves. What caught my eye recently was that during one of the latest drops in the S&P 500, the VX actually fell. And that's weird. Normally when the market drops, the VX spikes. But when they both go down at the same time, that's called a divergence. And it can be a sign that fear is starting to fade, and that the market is beginning to cool off a bit. To me, all of these signals suggest that maybe, just maybe, the worst is behind us. Sure, the market might still be wobbling for a bit, but technically, I'm starting to see signs of a potential shift, and I pay close attention to that. Doesn't mean I'm going all in right now, but it definitely means it's worth staying alert, and maybe getting ready. You know one of the things I always like to go back to when the market feels shaky? History. Because when everything's all over the place and emotions are running wild, it just makes sense to take a step back and look at how markets behaved in similar situations before. And when it comes to corrections, the numbers are actually pretty interesting. Let's take the S&P 500 as an example. Historically, every time we've had a sharp 10% correction, the market has had a strong tendency to bounce back in the following months. The data speaks for itself. Plus 6.3% 1 month later, plus 9.1% after 3 months, plus 4.9% after 6 months, and plus 20.8% after 1 year. And get this, the only time returns were negative 1 month after a sharp correction was during the COVID crash in 2020. And even then, it was just around minus 1%. In every other case, the market ended up higher after the dip. Now, here's the thing. This current correction, it ranks among the 5 fastest in the last 75 years. That's a big deal. The S&P 500 dropped nearly 10%, and the whole thing played out in just over 20 days. For comparison, the COVID crash lasted 8 days, the trade war drop took about 13 days, and now we're right up there. So, yeah, this isn't your everyday market pullback. And that's important to realize, because if you're experiencing this kind of volatility for the first time, it can feel like the sky is falling. But from a long-term perspective, these types of moves happen. And more often than not, they end up being some of the best opportunities, as long as you stay patient and don't panic. And here's one more thing. According to historical data, the strongest market days usually happen during corrections and bear markets. The biggest gains don't show up when everything feels calm. They tend to show up when the market is full of fear and chaos. And if you miss those days, it can cost you big time. When I look at everything that's going on, and I'm not claiming to be a guru or some kind of market prophet, just a regular investor trying to make logical decisions based on data, experience, and a bit of common sense, here's where I'm at right now. I'm not selling. If anything, I'm slowly averaging into the positions I already hold. I've made a decision not to try and time the market. Because if there's one thing history has made crystal clear, it's that most people who try to guess the perfect moment to enter or exit usually miss it. And when you try to outsmart the market, you risk missing those few key days that end up driving most of the yearly returns. That's a big deal, because those strong green days tend to show up without warning, often right when the market is recovering from a drop. That's exactly why I prefer to stay in the game and simply adjust my strategy as I go. In my long-term portfolio, I'm dollar cost averaging into positions, but I'm not adding to the big overcrowded names like Google or Microsoft. Those are great companies, sure, but they're heavily traded, and I think a lot of upside is already priced in. Instead, I'm more focused on smaller cap stocks that I believe are still undervalued and have real room to grow. And yeah, I know people have been talking for months about how small caps, especially in the Russell 2000, are cheap, but a big chunk of those companies are cyclical businesses, and when the cycle turns, they could be the ones leading the charge. For shorter-term plays, I also use options. One of the things I like to do is sell put options on stocks I wouldn't mind owning anyway. It's a way of entering positions while collecting a premium, a strategy that works well if you're careful and disciplined. It's a bit more advanced, but when used right, it can be a really effective tool. But above all, I don't try to be the smartest person in the room. I fully accept that I might be wrong. That's why everything I do is based on calculated risk, structured in a way that allows me to sleep at night no matter what the market decides to do. So, if we look at everything from a short-term perspective, things still feel a bit like a roller coaster. And like I said earlier, I'm not here trying to time the market, but I do watch key technical levels, not because I think I can predict the future, but because it helps me understand where the pressure points are. Knowing where resistance and support levels sit gives me some structure so I can be more prepared. Take the Nasdaq, for example, specifically the QQQ ETF. There's a really interesting level around 485. The price has tested that zone a few times already. And if it breaks above it, we could see what's called a short covering rally. That's when people who bet against the market start closing their short positions, and in doing so, push the price even higher. The next resistance level, that's the next major ceiling for the price, is around 500. And if we get there, the chart could start looking a whole lot more bullish. But, of course, we've also got to be ready for the other side of the story. Volatility is still high, and I expect that nervous energy to stick around at least until the 24th. That's why I'm also watching the 474 level. If the price drops below that, we could see a wave of stop losses getting triggered. Basically, a bunch of investors would automatically be forced out of the market, and that could cause a sharp, temporary drop, maybe even down to minus 15% from the recent highs. It might not last long, but it would still sting. That's why I keep saying the market is hypersensitive right now. Every headline, every announcement, especially around tariffs and trade, can cause a knee-jerk reaction. So, while technical analysis is useful, it's just one piece of the puzzle. It's also important to understand the emotional side, what the market feels like. So, I'm staying open to both outcomes. Either we break above resistance and kick off a rally, or we dip one more time before finding a proper bottom. Both are on the table. And to me, that's the whole point. It's not about guessing exactly what will happen. It's about being ready for whatever could happen. So, to sum it all up, we're looking at a market that's just gone through one of the fastest drops in recent decades. Volatility is still high, investor sentiment is extremely bearish, but on the other hand, we're starting to see some technical signals and historical patterns that suggest a potential reversal might be on the horizon. In the short term, things could still swing up and down. We might see another sharp dip, or maybe even a surprise bounce. But from a longer-term perspective, something definitely seems to be taking shape. And that's why I'm staying in the market, watching the data, adjusting my strategy, and most importantly, I'm not trying to catch the perfect timing. Because honestly, I don't think that even exists. Now I really want to hear your take on all this. Do you think we've already hit the bottom, or is it still ahead of us? Drop your thoughts in the comments below. I'm genuinely curious how you see things, whether you're watching technical levels, sentiment, or just trusting your gut. If you enjoyed this format, give the video a like. It really helps with the algorithm, and it lets me know that it makes sense to keep doing these kinds of breakdowns. And if you're new here, feel free to hit that subscribe button. On this channel, we dig into topics that'll make you think a little deeper. And if you're in the mood for more, check out the other videos on my channel. You'll find plenty there to explore. Thanks for being here. I hope you have a calm and steady day, and I'll see you again soon.